Hi, everybody. I'm Jerry Kronenberg, Director of Financial Content here at Moomoo Technologies Inc. And I'd like to welcome you to a very special webinar where we're going to be talking about the Oracle of Omaha, Warren Buffett. For those of you who are not aware, Mr. Buffett this past weekend did hold the Berkshire Hathaway annual shareholders meeting. And the highlight, as it has been for years and years past, is he spoke for hours taking questions from Berkshire Hathaway shareholders and giving some wisdom about life, about markets, and about everything in between. I am joined today to talk about what investors can learn from this by Justin Zacks, the Vice President of Strategy here at Moomoo. Justin, hello.
Hi, Jerry. Thanks for having me on the show. Wish I could have been there in person in Omaha. It sounds like a rock concert, 40,000 people, celebrities left and right, all kinds of booths, and in addition to the actual, general meeting. So have you ever been?
No, I'd love to go sometime. For those who also don't know, this used to be a super VIP event because Berkshire has never split its A shares, which are now more than $600,000, but they do have B shares, which are, I believe, $60,000. So a little more affordable. You have to be a shareholder to go, or maybe a member of the media or brokerage firm.
Well, the nice part about the Moomoo app is you can trade fractional shares. So maybe you don't have $600,000 to blow on one share of Berkshire A, but you can take a fraction of that if you want. So that is the nice part of our fractional share program.
Absolutely. So again, this is a shareholder meeting that Buffett they hold every year at about this time, and the highlight is a Q&A. Buffett, who is 93 years old, spoke for almost 5 hours, taking questions from the audience, and he said a lot of interesting things about the markets, about investing, and more. What were some things that you found interesting, Justin?
So I guess the biggest thing that I look at, a lot of people go immediately to these individual stocks that he's buying or selling. The first thing I do is look at, did he buy or sell on a net basis? And what you found this past quarter one, was he was a net seller of $17 billion of stock in his portfolio. And the cash levels of Berkshire are now, like, I think, almost $190 billion. They'll probably eclipse $200 billion this quarter. So if that's an all-time record, and that shows me that he's not finding enough opportunities of great value stocks to invest in. And he had this quote. It's like, if you're doing value investing, you want to make sure you have some of this money available when there are values. And right now he's not finding enough. He said things aren't attractive.
Right. I thought it was interesting that he said they're going to, as he said, about $200 billion. And to me, he said something telling, which is, look, we're not going to just throw money after stuff. We're going to keep in cash if necessary, which tells you something about the expensiveness of the market right now. But he also said, hey, we're getting 5%-ish interest rate, and we'll take it. We do it into 1%. So to me, it says a lot about the markets, but it also says something smart about strategy that every investor should pay attention to, which is there are 3 investment classes. There are stocks, there are also bonds, there are also money markets. And it's probably a good idea to think as an investor about more than just stocks. You don't have to be all in stocks all the time. Depends on where you're going with your portfolio, but I thought that was an interesting lesson. Was there anything else that struck you?
Yeah, I mean, obviously that's a big lesson for them, and obviously the interest they made is great. And what the other interesting part was, what else did they do with their investments? And obviously, probably the biggest news was Apple. So Apple is their biggest stake. It's something like 40% of the portfolio. So they cut back 13%. But Buffett didn't really have too much bad to say Apple. So this sounds like some type of a risk management. And to me, it's kind of these 3 little buckets. One is that overvaluation. And I know you had some stats on Apple in terms of, like, what's the valuation in Apple look like now?
It's about a 28 price to earnings ratio on a trailing basis versus about a 22 on the S&P 500. Dividend yield is about 0.5%, I should say. The S&P 500 is about 1.4%. So not a cheap stock, not what you usually think of as a Buffett stock.
Yeah, and in its growth cycle right now, it's not hitting on all cylinders. So I think it's waiting for this AI possibly to kick in and be valuable there, but we haven't yet to see it translate for Apple. And if that doesn't happen, particularly without that, mega growth that we see out of some of these other tech companies, that could be, on the expensive side. The other part is this idea of diversification. once your position gets too big, I mean, is this Berkshire Hathaway or is it, Apple B shares that you're really talking about? So at some point you have to say, as an investor, there's benefits in diversification, and you want to cut back some of that to make sure that one stock doesn't dominate your portfolio. So, that's one reason. The other, he didn't mention that. Another reason he did mention was this idea of change in corporate tax rates. So we have an election coming up. No one really knows what's going to happen with this election. And whoever gets in there, you still don't know what's going to happen with corporate tax rates. But the chances are corporate tax rates are not going down from here. They're only going to go up. So these margins these companies have experienced over the past few years have just been record high after record high, owning to the interest rates. And I want to talk a little bit more about interest expense. So a company like Apple, they're sitting pretty because they borrowed a ton of money a couple years ago at like 1 or 2%, and now they're making 5% on their money. Eventually, other big companies did the same. Eventually, some of these bonds and bills are going to start rolling off their balance sheets, and they're going to have no choice but to borrow at 7, 8, 9. Some of the less stable companies are going to be borrowing double digits. This eventually will hit margins. Taxes could hit margins. So these are going to bring, you think it's on, a 28 or 22 multiple now. Imagine what that might be if we see some of these changes in interest expense and in taxes.
Right. Now, another thing that was interesting, that was newsworthy, especially, is that Mr. Buffett talked about the company's stake in Paramount, the entertainment company. They bought a 15% stake in the company in 2022. They disclosed in February in a filing that they had sold about a third of it, and he disclosed over the weekend that they just dumped the rest. He said some interesting things about that. What was your take on that?
What I really loved about, and what makes Warren Buffett such a great investor is he admitted he was wrong and he got out of the trade. So many people, not only do you lose money on a bad trade when you stick with it and it keeps going down, it keeps going against you. It affects you psychologically, and then that money, you cannot put that money to work in a good trade. Like, the guy's a brilliant investor. He realized, well, this is wrong, and he took full responsibility. So it's like, don't blame someone else when you do a bad trade. You're the trader. You made the decision. Take that responsibility. That's one of the best lessons I think you can learn from trading, is not necessarily when you have, a home run. It's when you make a mistake, you take responsibility, you limit your losses, you get out, you move on, you learn from that lesson. And he talked a little bit about, he's wildly invested in a lot of consumer companies, including Apple. And he said he made a few mistakes before he got to Apple. But then when he saw that people would rather own an iPhone than a second car, that's when he knew. But he had to go and study those consumers all the time. And that was one of the other things that really struck me about, a younger investor was there. What was the question that younger investor
Yeah,
asked?
that was very interesting, that he talked a lot about some life lessons. And one of the things he said there, he got a lot of questions, not just about stocks, but also about life lessons. But one was, a younger person said, what's your advice? You're 93 years old. What's your advice to a young person? He said, that was quite poignant: think about what you want your obituary to say when you're gone, and then start making it happen. So I thought that was quite interesting there.
Yeah, and
Right.
I think that some of those younger investors also asked him about, what would you do? And one of the things that struck me was, like, if I was younger, or when I was younger, he says, I would read over thousands of pages of research from analytical companies. And the great part is, at Moomoo, we have access to all of this research, and it's just another great, valuable lesson you can learn from Warren Buffett, is do your homework. I mean, the guy, doesn't. It seems like all he does, in his free time is read stockholder reports and analysis, of all these thousands of pages. But that's how you really get to know companies. That's how you get to know markets. And all this information is available on the Moomoo app, which is great.
Right. Well, the other thing he said regarding Paramount, he said a few things I thought were quite interesting. He said, look, I learned a lesson. It cost me a lot of money, but I learned a lesson. And he said that in investing, he's made a lot of mistakes, but you learn and you get better as you go along. And I thought it was interesting, a couple of things, that you can learn, I think, longer term, which is, again, don't necessarily stick with a loser. This is something that I fall into, that I'll hang on to something and hope it breaks even. And the best investors I know do not do that. They will admit defeat. They will usually, when they buy a stock, they will have a price they're going to sell at if it's going well, and the price they're going to sell at if it goes poorly, and then they just passionately do that. And so he basically was, as you said, taking ownership of it and saying, look, I made a mistake. I haven't been perfect. That's another thing that I thought is interesting. The best investors I know will say, look, we don't hit home runs all the time. It's just about being right more than you're wrong, which I thought was interesting. Now, is there anything else that struck you from that he said, either in terms of, again, the markets or knowledge or just life?
Yeah. So, well,
Mhm.
so he talked a lot about stocks. Then he also talked about the operating company. In Berkshire owns a ton of businesses, home building, railroads. Didn't do quite well, but what did do well for the company and is kind of their star of the company is their insurance business. And what struck me, what he talked about there was inflation was good for the insurance business because he's able to pass those costs along. So if anyone's taken a look at their auto insurance rates, at their homeowners insurance rates, they are through the roof in the last few years. And they've been able to pass this inflation along. So it's something to think about when you go and analyze these companies to make an investment. Are they able to pass the costs of inflation along to the customers? And if they're able to do that, they're going to make more revenue. If they're going to make more revenue, and if as long as they keep that profit margin the same, they're going to make more profits. So they're going to be more profitable, higher, high growth, high revenue, and they're able to do that. And so you got to identify the companies that are able to do that. And it looks like, at least in this case, in this specific case, the insurance business was able to do that. Um, the other thing he really talked about was, his business partner and dear friend Charlie Munger passed away, and he had always uh, looked at him for advice, and now he's getting older and people worried, like, who's going to take over. And he has a very good succession plan for his executives there. And so to me, that's a lesson I think you need to take on a company level. When you go and invest, you got to think, well, if this person is no longer the CEO or chairman, what will happen? And look at a company, say, like Tesla. Think about what might happen if something happened to Elon Musk. I mean, does he have a great succession plan? And you can argue that's not really the case. And then the other side of it that Buffett mentioned was you should always have a will. So from a personal finance aspect, you should have a succession plan to take care of your loved ones, your family, your friends, whomever that is. So things happen unexpectedly, unfortunately, and no one wants to be so morbid and think about all these types of things. But at some point, you do need to think about that. Make sure you have a plan personally if something would happen to you.
Great. Now let's talk a little bit also about how is Buffett becoming Buffett now, or became Buffett. Now, this session they just had, Tim Cook, CEO of Apple, was there. You mentioned that Bill Ackman, the billionaire investor, was there. Various celebrities have been there in years gone past. Why is he so followed, revered? They call him the Oracle of Omaha. Why is he so revered on Wall Street?
Well, I think the number one reason is consistency. Look, he's done it for how long? I mean, what are his
No,
returns compared to the S&P
we were just
500?
looking at that. He, from 1965 to 2023, so we're talking almost 60 years, 19.8% average annual return versus 10.2% for the S&P 500. I don't know that anyone can say those kind of returns for that long a period of time. So
Yeah,
that is
and so that's the
yeah.
consistency, and I think people appreciate his long-term view, the idea of value. Value investing's out of favor right now. Everyone wants momentum, FOMO, growth at any cost, but he stuck to his guns. He's done this value investing, and people thought, oh, he's old, he's outdated, and yet he continues to beat them all. And so, it might not work out 3 months, 6 months, but down the road, like you said, 60 years, he's proven that value investing works. And I think a lot of people really like that. He's also uh, really smart, but he's also very down to earth. He can take a lot of these complex financial subjects and explain them in layman's terms. And when you want to talk with someone about an investing, it's like, make it simple for me. you don't, if you're giving someone a complicated thesis, that doesn't necessarily work. Make it simple. And that's the way he invests. If he doesn't understand it, he's not going to invest in it. And that's another great lesson you can learn from Warren Buffett is you don't have to be invested in every single stock. You don't choose the hardest thing to do. Choose the easiest thing. So if something looks like a home run to you, do that trade. Don't try to take on a trade. Well, I'm not sure and I don't understand this, and maybe I should just bet the farm. That's not what you want to do.
Well, he said, for instance, AI, he said this about many technology things. I believe he said about AI, look, I don't understand it. And so he doesn't, he said many times, I don't invest in things I don't understand. Well, we're starting to run low on time here, but were there other things that struck you that you want to talk about, either personal or financial, that you gleaned from this?
Yeah, I'm going to read you one last quote that I got from him. He talked a lot about Charlie Munger, and he talked a lot about how much he trusted him. But this is one thought when you think about all this and the people you love and the people you talk to about investing. And Moomoo has this great community where you can go in and your family might not know that much about investing, but you might not have a lot of friends that do, but we have 21 million users, and hopefully you can find someone that you identify with that you can chat about investing in the Moo community. Because I'll read you this last quote. He says, "I trust my children and wife totally, but that doesn't mean I ask them what stocks to buy." And that's a quote I really thought about. Is just because you love someone or trust someone doesn't mean their opinion is golden on every subject. So you should balance that when you're making investment decisions. So something to think about and take away from our conversation.
Well, I saw a number of interesting things he said that were not having to do with investing. Again, he's 93 years old. He just lost his colleague of many years, Charlie Munger, who was almost 100 years old. He died just short of 100 a few months back. But he talked bluntly a lot about his own mortality. He said at one point, well, one thing that I'm not doing is I'm not getting our standard 4-year contract that we give our executives here at Berkshire Hathaway. So he's very, very forthcoming. And I think we'll end it with what I thought was a very poignant, essentially, end to his talk. He said, thanks for coming. I'm paraphrasing a little bit here. Thanks for coming. I hope to see you all next year, and hope to see me here next year too. So
yeah, and I hope we do get to see Warren for several years to come, and that he continues to eat those cheeseburger and Cokes, and that it keeps him around, because I think everyone has benefited from his investing knowledge and his wisdom.
All right, great. Well, Justin Zacks, we're going to leave it there. Thank you for watching, everybody. And for the latest best news, information, and community, check out the Moomoo app every trading day. Thanks for watching and happy investing. I'm Jerry Kronenberg. Have a good day.